Welcome to the Women's Money Wisdom Podcast. I'm Melissa Joy, a certified financial planner and the founder of Pearl Planning. My goal is to help you streamline and organize your finances, navigate big money decisions with confidence, and be strategic in order to grow your wealth. As a woman, you work hard for your money, and I'm here to help you make the most of it. Now, let's get into the show. You filed your tax returns. Now, what do you do next? We want this episode to be actionable, quick, but very relevant and timely so that you know what you need to do next after you've gotten through this important step. We will have action items for people who have failed to complete their tax returns so far on today. It's April 16th. Action items for those who paid too much or too little, and where you can go next to make sure that you are on top of your tax game. Welcome back to the Women's Money Wisdom Podcast, here today with Melissa Joy. So we thought today's episode was perfect because some of you may be mailing off or e-filing your tax returns over the weekend or on Monday. And so now here we are, but this is a perfect time to grab your attention and get a few more things checked off the list when it comes to tax season. You know, we find that people that reach out to us often have taxes on their mind. Even though we're financial planners and not tax preparers, enrolled agents, and CPAs, you know that financial planners are thinking about your taxes when it comes to our advice. And so oftentimes when you just end up pulling out your hair saying taxes are the worst, you're telling us that when you engage with us, and we're really trying to help you. So we're thinking about taxes all the time when it comes to your investments, when it comes to your income from your job or the work that you do or your retirement portfolio. And I want you to have the information that I would want to hear myself when it comes to what to do in late April once you have your taxes filed. First of all, if you work with financial professionals that aren't talking to you about your taxes, there really are people out there that do keep taxes in mind. I hear this all the time where people that are financial advisors are only thinking about investment accounts and they're not really putting on that tax hat. In fact, at some financial institutions, they don't even let their advisors talk about taxes. But we think that's really backwards. The way we handle things, and many other people like us, is we want to see your tax return. We want to look at it and keep that information in mind, keep your current tax situation in mind through all of our decisions and thought process when it comes to analyzing and understanding your circumstances and providing you with advice. So I just want you to know that there are alternatives out there, and that if you aren't having those tax conversations, either ask your financial professional whether you can, or perhaps look elsewhere. So let's talk about some action items. I've gotten it broken down into 5 suggested steps for those of you who are like, okay, I'm eating this up. I really, don't take all day, Melissa, but do tell me some things that would be helpful for me in my life. And the first thing I want to take care of is those of you that are just sitting there like, I'm listening to this because I did not complete my process for this year. And I get that, like some people, and especially nowadays, tax professionals are under the gun and documents come later and later, which is natural in some cases. And so you're just sitting there like, I haven't filed yet. But if you didn't have a tax professional, you're doing it yourself, and you ended up missing the deadline, then please make sure you go and file your 4868, which is the United States form for the IRS. You can find it on the IRS website, and I'll include that in our show notes to get an extension. With that extension, you also want to look up what is required by your state. We have clients all over the country, but I just had to look up what happens in the state of Michigan because we are located in Michigan. Many of our clients are in Michigan. And I had a client reach out and say, the person I was supposed to reach out to back in January, I didn't do it. And so she doesn't have time to get my taxes done before the deadline. And so, Google is your friend here. It's pretty straightforward advice. I would take your advice straight from the source. So go to the IRS, go to your state. But in the case of the state of Michigan, they want to see your federal extension. So the form that you filed federal, that 4868 from the IRS that I'm sharing with you in show notes. And then they will give you an extension to the typical time that extensions can be filed, which is October 15th. Then make it, if you're planning to use a professional, make an action plan to reach out to them. Now, they have just gotten through a very busy season, one in which many of them work at least double the standard 40 hours a week, if not more. So give them a couple days or a couple weeks, but do reach out, go ahead and schedule your email and have it set to hit send for a week from now. And do nudge. If they don't get back to you, find somebody else who will, and do make a game plan for filing your return, because you don't want to be sitting in the same circumstance next October. But I just wanted you to know how to extend if you're sitting there thinking, oh my gosh. And you're not alone if you extend. If some of you are listening in and you do have to extend for a variety of circumstances, whether there just wasn't time for you to get things done or you didn't have all the information, which is possible depending on what types of returns what types of income you have, that's okay. So you're not alone. Many people end up filing extensions. In fact, in my experience, more and more each year. So don't feel like you have a scarlet letter, but do make an action plan for how to get things done. So another piece of information I want you to be aware of is that tax withholdings, if you are someone who has W-2 income, can be super wonky nowadays. The form kind of changed recently. It's harder to understand, and people end up having tax withholdings kind of being okay, and then all of a sudden they're way off. So if you just ended up not hitting the target for where you usually are in terms of paying enough and things like that, I do want you to consider revisiting the withholdings you're doing if you are a W-2 employee who gets a regular paycheck out of payroll from your employer. I'm going to include links for a tax withholding estimator, and that will help you. But I also would recommend having a conversation with the people that are helping you file your taxes if you're working with a professional, because these withholding elections tend to be not spot on nowadays. And it's just different than it used to be. And your professional will have some good advice about what you should be doing. If you're not working with a professional, like I said, there's a tax withholding estimator. I just find that you're not alone if you're ending up surprised. Like, I thought I'd withheld enough. I did everything the same as I used to. And then it's like, oh no, surprise, you're way, way off. Okay. So make sure you're adjusting your withholdings, and don't assume, like, if you got a surprise bill or a surprise giant refund too, don't assume that your tax preparer is going to have time during tax season to say, oh, here's the perfect amount you should withhold. Do a follow-up if you think that you need to have that discussion, because they may or may not had time to kind of consider your specific options. So I want you to be aware of that. Now I'm going to speak to a group of people who may be a little bit upset about tax season. Those who ended up owing a lot of taxes. You really feel like your tax rate is too high. Here's what you may need to consider if there's not going to be a change in your circumstances and you're going to have similar income in the following year. First of all, do make estimated payments if you can figure that out. Estimated payments end up being paid in June, September, and January. That's not every 3 months. So it's kind of a head scratcher in terms of times of the year. The other estimated payment would have been made on April 15th. So you could make an estimate. In some cases, your tax preparer would say you need to pay this much for your federal obligation, as well as make the same estimate the same day. And you're like, oh, double whammy, but it's helping you to prepare for next year. So do get information about your estimated payments, and your estimated payments are going to end up being either based on what is going to happen in this current year or based on an estimate from what your tax obligation was in the previous year. So your tax preparer can give you information about the appropriate amount that would be a safe harbor so that you don't end up with penalties. And then if you're really sure that you're not going to end up having as high of a tax obligation, you can talk to your tax preparer over the year. So let's say you are expecting a bonus over the summer and then it comes in lower than you expected. Well, you can then adjust your estimates for September and January, or in some cases, your income ends up being lower, you have really good estimates, and then you don't even have to make a January payment. It's flexible that way, but you want to make sure you're getting the payments in over time as you go, because the IRS doesn't like you to wait until the next year in April to kind of make that payment. So do make estimates if that's recommended to you. Also, again, do that withholding review. And if you're receiving, as many of our clients are, equity and stock compensation, for example, in the form of restricted stock units or RSUs, you can actually go in if you're kind of coming in under and make an adjustment to the amount that is being withheld for those. So you could potentially change it from the standard 22% to 37%. Those are the typical numbers for your federal withholding, and double check on the state withholding as well. That's another thing to think about. Another consideration is like maybe your income is the same, but your spouse or partner that you're filing with has different income and that's been going up or down. That can really hit you. So it's important to coordinate not just with your information, but with your partners. And if you're a business owner, your income can be all over the place depending on the year as well. And so do be cognizant of exactly what's going on right now. And if you end up just having too much of a tax hit, the other thing I encourage people to think about is maybe you want to switch if you were making Roth contributions for your retirement plan, where you don't get an immediate tax break, but you get a tax break when you take money out, to traditional contributions that have more flexibility to get a higher immediate impact in terms of lowering your tax bill. These are just a few of the ideas. I also am going to mention later that you should analyze the tax cost of your investments because it can vary wildly based on the type of investments that you own. So let's move on and let's talk about what if you got a big refund? Well, for some people, this is kind of your emergency reserves. Use that money for a kind of a buildup of emergency funds, rainy day funds, or else you make bigger payments for things that come up along the way in this time of year. And, if you were just purely professional who looked at things from purely a textbook perspective, they may be saying, no, that's not good because you could have had that money in your hands and earned interest. But I know that behaviorally, this feels good and feels right for many people. And I'm just fine with that if that's intentionally the way you want to be. But if you're not that way, if you do want to have that cash in your hands and you rather get paid interest, which could be 4 or 5% nowadays in 2024, then I would encourage you to, make some adjustments, especially if your income is going to be similar this year, so that you're paying less in taxes because you can anticipate that you will have a lower tax obligation, the same as you did this year, next year. And so actually going the opposite direction and lowering your withholdings instead of boosting them could be appropriate for you. And then also you could switch from the opposite of those retirement contributions from traditional to Roth in that case. And additionally, just talk with everybody involved, your tax professionals and or your financial planner, and kind of make a game plan. Maybe there was just a strange reason for this year. Now that we have interest rates higher, you can also find that more and more people are itemizing because they may have bought a house after interest rates went higher, and then you have a higher propensity of adding your property taxes plus your mortgage interest, and it ends up being more than the standard deduction, which had really been kind of grabbing a lot more people than typical for the last few years. But we're starting to see itemized situations creep back in more and more for people. So that may be the case too. And you may just have a permanent kind of adjustment to your tax circumstance or situation. Another thing that I think is very important and sometimes gets missed, not every financial planner is thinking about it, but I wish they would, is there are tax costs associated with your investments that may be embedded that may not be necessary. So I'm mainly talking about people that end up with taxable investment accounts. So I'm not talking about your IRA or your Roth or your 401k, but I am talking about your joint accounts or your brokerage accounts where you're trading investments. In these cases, certain investments, for example, ETFs, may be inherently more tax efficient than old school mutual funds. And if you're trading a lot, it may be less tax efficient than if you trade less frequently. I'll include some information on how to be tax aware when you invest in our show notes, but I would like you to be aware that you ask your CPA, why did I owe more this year? And they say, well, your 1099 from your investment account came in with a bunch of income or capital gains. Okay, let's think about that. In some cases, that might be very appropriate. In other cases, there may be options to improve it. Don't jump to conclusions, but if you're working with an advisor, bring it up. and say, hey, my CPA said a lot of my tax liability came from capital gains that came from this account. Is there anything we can do about that to be more tax aware? I think with a good financial planner, they will talk to you about, hey, here's what it came from. Here's the circumstance we were in. This is why it's coming up. In our case, we end up sometimes, we are aware of capital gains as they go, and it'll be a conversation throughout the year of like, we may need more taxes and here's why. I can think of one example this month where I'm needing to raise a significant amount of funds for a tax bill that's coming up for a client because of equity compensation. So they're getting paid a lot of company stock, and that just ends up being a bigger tax bill in the hundreds of thousands of dollars. And so I had the discussion when we were talking about raising some money to make that tax payment of I was able to do a trade that will have this much in capital gains, which in your case, because you're in a high income, you're going to be at the 20% capital gain bracket most likely, and thus you will have a tax bill for this trade that's raising the cash for your tax check of this amount of money next year, all things being equal. So speak and work with financial planners that can talk taxes and keep you aware over time and not kind of create surprises for you. Now, sometimes your tax preparer may think, why were there so many losses in your financial advisor's accounts? I will tell you that your tax liability is not always the same as your investment returns. And so do have that conversation translating the tax costs with the investment returns. So in our case, we love to make money for our clients without creating a big tax bill. And we can't do it every day. It just depends on the year. And certainly past performance does not predict future returns. We can't completely control for taxes. But sometimes we have CPAs that are like, we really need to think about what the returns were. And we'll talk to both the client and the CPA and say, hey, tax costs were low, yay. The investment costs were different and higher. And these are just hypotheticals. We're not predicting the way things would go. I'm just saying that there can be discrepancies between the way a tax person who really, when they see taxes, they think gains and returns, sees the world versus how a financial planner who's thinking, how do I avoid taxes while making money, if the opportunity presents itself. So those are some, kind of thoughts. I'll tell you what we end up doing with our clients is we receive, whenever our clients are willing to do it, a copy of their tax return. We run it through a piece of software that we use so that we're able to see your taxes and explain it to you in a very straightforward manner where you can see like your average tax versus the highest tax bracket you're in. You can see whether you're eligible for Roth contributions versus traditional contributions. If you have kids in college, you can see how close you are to eligibility for tax credits and things like that all over the board. Let's say you're a retiree and you need to be thinking about IRMA charges for Medicare. Well, we can tell you how close you are and how much you would end up paying if all things were being equal. Then we use that information from the previous year. So we use the hindsight, the rearview mirror, to be able to run some scenario analysis and considerations for your next year. And then, we can do analysis on, should I do a Roth conversion? Or what if I elected an S Corp if I'm a business owner? Things like that. So that is a really helpful way for us to both have and explain your tax circumstances in a way that's different than your tax preparer. It does not take the place of a tax preparer, and we're not giving you advice separate from a CPA or enrolled agent. We're just kind of tax adjacent. But it helps us to be knowledgeable about your circumstance, and then it also helps us to plan and advise in consult with your professional for the year in the future. I really hope that you have some good talking points, some interesting things to chew on, and also a couple ideas of things that you might want to consider, things to bring back to the kitchen table at home, and or reach out to your financial planner or someone like us to have a follow-up discussion, because this is absolutely the right time of year. If you just went through the last tax season and you're like, I don't want to do that again, there's no time like the present to start planning. It certainly doesn't work to wait until you are under the gun to file your taxes for the next year. So take that with a grain of salt and Congratulations on checking it off the list. And if you're one of those that had to extend, that's okay. You'll be getting it done soon. We know you can. And have a great week. Happy April. Thank you for listening to the Women's Money Wisdom Podcast. If you found value in this episode, the best way you can support the podcast is to forward an episode to a friend or leave a review. Go to pearlplan.com and the podcast link to get all the resources and links mentioned.